In September 1998, the smartest men on Wall Street were quietly going broke. Two of them had just won the Nobel Prize in economics. Their partners weren't ordinary traders. They were the traders other traders were afraid of. The people who had spent decades turning tiny cracks in the market into billions of dollars. Together, they had built something that looked less like a hedge fund and more like a money printing machine. A machine so precise, so mathematically certain, that on paper, it simply could not lose.
And the most powerful banks on earth believed it. They lined up, Merrill Lynch, Goldman, the giants of global finance, begging to hand this one fund their money, sometimes their own partners' fortunes. For 4 years, the machine worked. It returned 40% a year. It made its founders legends twice over. And then, in roughly 100 days, it lost $4.6 billion and came within hours of pulling the entire global financial system down with it.
This isn't a story about greed or fraud or stupidity. That's what makes it terrifying. It's a story about the smartest people in the room, using the best ideas money could buy, building a bomb none of them could see they were sitting on. And when it finally went off, the only thing standing between them and a worldwide collapse was a quiet, desperate meeting inside the Federal Reserve. A rescue that would not cost taxpayers a single dollar, but would rewrite the rules of who gets saved when the money runs out. To understand how the most brilliant fund ever assembled destroyed itself, you have to go back to 1994, and to a man who had already blown up once before and swore it would never happen again. His name was John Merriweather, and in the world of bond trading, he was a legend. At Salomon Brothers, Merriweather had built the most feared money-making machine on Wall Street, a small, secretive group called the Arbitrage Desk, where a handful of brilliant, socially awkward men used mathematics to find money everyone else had missed. For years, they were the single most profitable thing inside one of the most powerful banks on earth. Merriweather rose to vice chairman. And then, in 1991, it all came apart. One of his own traders had been caught cheating, secretly breaking the rules of United States Treasury bond auctions, using clients' names to place bids far larger than the law allowed. Merriweather hadn't done it himself, but it happened on his desk, on his watch. He resigned in disgrace, paid a fine, and walked away from the firm that had made him famous. For most people, that would have been the end. For Merriweather, it was fuel. He believed more than ever that his approach to the markets was right, and he was going to prove it with his own fund. So in 1994, he built it. And he didn't just hire good people. He assembled what may be the most intimidating collection of financial minds ever put in one room. He brought over his best traders from the old Salomon Arbitrage Desk, the loyalists who had made billions with him before. Then he added the professors. Myron Scholes and Robert Merton weren't just academics. They were the men who had essentially invented the modern mathematics of risk. Work so important, it would win them the Nobel Prize in economics in 1997. And to erase any last doubt, Merriweather recruited David Mullins, a former vice chairman of the Federal Reserve, a man who had helped run the American financial system itself. Think about what that signaled. The best traders on Wall Street, the greatest financial minds in the academic world, a former central banker, all under one roof. This wasn't presented as a hedge fund. It was presented as a certainty. Investors didn't ask many questions. They begged to get in. Merriweather raised $1.3 billion before the fund had placed a single trade. But all of that talent, all of that money, created a problem hiding in plain sight. To earn the returns these people expected, being smart wasn't enough. They would need a strategy that could turn differences too small to see into billions of dollars, and a way to make those tiny bets enormous. What they built next was brilliant. It was also, though none of them knew it yet, the exact machine that would destroy them. So what did the machine actually do? At its heart, the idea was almost boring. All over the world, there are pairs of investments that are nearly identical, but priced just slightly differently. Two bonds that will pay almost exactly the same thing, where one costs a fraction more than the other. In a perfect market, that gap shouldn't exist, and over time, it usually closes. Long-term capital strategy was to hunt down those tiny differences and bet that they would disappear. That was it. They weren't gambling on whether stocks would rise or fall. They were betting on something that felt far safer, that two nearly identical prices would eventually come together. Traders had a name for this kind of strategy. They called it picking up nickels in front of a steamroller.
But there was a problem with picking up nickels. A nickel is worth 5 cents. To turn that into the kind of money that would satisfy the smartest people on Wall Street, you had to do two things. First, you had to make each bet gigantic, not thousands of dollars, but billions. And second, since your own money would never be enough, you had to borrow. And borrow, long-term capital did. For every single dollar the fund actually had, it borrowed more than $25 from the banks. At its peak, the fund controlled positions worth over $1 trillion, balanced on a thin sliver of real cash underneath. Leverage like that is a magnifying glass. When the tiny bets paid off, the profits were enormous. But the same glass works in reverse, and no one inside was looking through that end.
To the men who built it, none of this felt reckless. It felt scientific. Their models, the same mathematics that had won a Nobel Prize, told them the odds of losing big were so small, the loss should essentially never happen. Because the bets were spread across different markets and different countries, the models assumed they could never all go wrong at the same time. One might lose, the others would hold. That was the foundation the entire machine rested on, a single quiet belief that the future would behave like the past, that markets always return to reason, and that trouble in one corner of the world stays in that corner. It was an elegant assumption. It was also about to meet the real world. But not yet, because first, for 4 straight years, the machine would do exactly what its creators promised and make them richer than they had ever imagined. At first, the machine performed exactly as promised. In its first full years, long-term capital didn't just make money. It made money at a pace almost no one on Wall Street could match. Returns of roughly 40% a year after fees. And it did it without the wild swings that usually come with profits like that. Without a single losing stretch worth remembering. To outsiders, it looked like the impossible had finally been achieved. Enormous returns with almost no visible risk. The partners grew rich, many of them hundreds of millions of dollars rich. And their reputation, already legendary, hardened into something closer to worship. These weren't traders getting lucky. In the eyes of Wall Street, these were the people who had finally figured the market out. And Wall Street wanted in, not just to invest, but to be near them. Banks competed for the privilege of lending long-term capital money, and they competed by offering terms they would never give anyone else. Normally, when you borrow to trade, the lender demands a cushion of collateral in case you lose. Long-term capital was so trusted that it borrowed with almost no cushion at all. Banks handed over billions and asked for next to nothing in return, afraid only that a rival might steal the relationship. The most sophisticated institutions in the world were effectively financing the fund's bets for free and barely looking at what those bets actually were. Everyone assumed someone smarter had already checked the math. By the end of 1997, the fund had a stranger problem: too much money. It had grown so large that the tiny pricing gaps it hunted could no longer absorb all its cash. So the partners did something almost unheard of. They pushed billions of dollars of outside investors' money back out the door so they could keep more of the profits for themselves. They were that certain. And to hold their own enormous stakes, some of them borrowed even more. Every decision now rested on the same quiet assumption from the very beginning, that the markets would keep behaving. For 4 years, they had. But half a world away, in a country the models treated as just one more small risk, something was about to break. And when it did, it would not stay in its corner. The first tremor came in 1997, when a financial crisis tore through Asia. Markets shook, but long-term capital held and even profited. It seemed to prove the models right. Trouble came, and the machine absorbed it. But that near miss carried a lesson the partners read backwards. They didn't see a warning. They saw confirmation. Then came August of 1998. Half a world away, Russia, a nation the models treated as a small, contained risk, did something the textbooks said serious governments simply don't do. It defaulted. It refused to pay its own debts and let its currency collapse. On its own, Russia was almost a rounding error in the global economy. What happened next was not.
Because the moment Russia broke, something changed in the mind of nearly every investor on Earth at the very same instant: fear. All over the world, money stampeded toward safety, toward the few assets everyone trusts in a panic, and away from anything complicated, anything risky, anything hard to sell quickly. And almost every position long-term capital held sat on the wrong side of that stampede. Here was the flaw in the foundation, exposed all at once. The fund's bets were supposed to be independent, spread across different countries and markets so they could never all fail together. But panic does not respect those boundaries. In a real crisis, everything risky falls at the same time. The bets that were never supposed to move together suddenly moved as one, and they all moved against the fund.
The gaps that were supposed to close instead ripped wider. Every model said these prices should be converging. Instead, day after day, they flew apart. And now the magnifying glass of leverage did its work in reverse. Losses that would have been survivable for an ordinary fund became catastrophic for one borrowing more than $25 for every dollar it owned. Long-term capital began losing hundreds of millions of dollars in a single day. Then it happened again and again. In a matter of weeks, nearly half of everything the fund had was simply gone. The smartest men in finance sat at their screens and watched their certainty evaporate, and slowly understood that the machine they had built could not stop falling. But their losses were no longer only their problem, because to place those bets, they had borrowed from nearly every major bank on Wall Street. Now, the fund was trapped. To calm the banks it owed, long-term capital needed to sell, to raise cash and shrink its enormous bets. But it couldn't. Its positions were so massive that trying to sell them only pushed the prices down further, deepening its own losses with every trade. And it was worse than that. Much of Wall Street had a good idea of what long-term capital was holding. Rival traders, sensing blood, began betting against the very positions they knew the fund would eventually be forced to dump. The smartest fund in history had become a wounded animal in a market full of predators, and every move it made left it weaker. Each morning, the banks called, demanding more collateral the fund no longer had. Each afternoon, a little more of it died. Merriweather started making desperate phone calls, searching for anyone with enough money and nerve to save them. He reached out to the legends of finance, among them Warren Buffett, who helped assemble a group willing to buy the fund out from under its partners for a small fraction of what it had once been worth. The offer was brutal, almost humiliating, and through some mix of pride, confusion, and a legal technicality, it fell apart. The lifeline slipped away. Time was running out, and the private market had just said no. There was only one place left that could stop what was coming, and it wasn't a bank. It was the Federal Reserve. At the Federal Reserve Bank of New York, officials had been watching with growing alarm because they understood something the public did not. Long-term capital wasn't just a fund about to fail. It was tied through more than $1 trillion in contracts to nearly every major bank on Wall Street. If it collapsed all at once and dumped its positions into a market already gripped by fear, it might not take down a single fund. it might drag the others down with it and freeze the flow of money through the entire system. This was the nightmare regulators feared most. Not that one player was too big to fail, but that one player was too connected to fail. And so, in the third week of September, the Federal Reserve did something extraordinary. It picked up the phone and summoned the most powerful bankers in America into a single room. On September 23, 1998, the leaders of Wall Street's biggest banks filed into the Federal Reserve Bank of New York. These were fierce rivals, men who spent their careers trying to beat one another. Now, they sat around a single table because the man who ran the New York Fed had made the stakes brutally clear. Long-term capital had perhaps days, maybe hours before it failed. And if it failed the wrong way, every bank in that room would feel it. Many of them had lent the fund money. Many held the other side of its trades. If long-term capital went down in a fire sale, it could set off losses that reached each of them and millions of ordinary people who had never even heard its name.
The Fed itself would not spend $1 of public money. Its power here was subtler. It put the banks in a room and forced them to confront a truth none of them could escape, that they needed each other to survive this. The proposal was blunt. Together, the banks would inject billions of dollars into the dying fund, take it over, and unwind its enormous bets slowly and quietly over months, instead of all at once in a panic. It was not charity, it was self-preservation. One by one, the banks agreed, each pledging its share, but not everyone. One major firm, Bear Stearns, refused to put in a single cent, a decision the others would not forget. In the end, 14 banks committed roughly $3.65 billion. In exchange, they took ownership of almost the entire fund, around 90% of it. The partners, the geniuses who had built the machine, watched their stakes and most of their personal fortunes vanish, reduced to passengers in the company they had created. And then, almost as quickly as the panic had risen, it eased. With the rescue in place, the markets exhaled. The chain reaction the Fed had feared never came. The system had been pulled back from the edge, not by a bank failing and not by public money, but by a private deal forced together in a single afternoon. Yet the rescue that saved the system also left something dangerous behind. A question, and an example that Wall Street would remember for a very long time. In the end, the rescue worked. Over the following months, the banks slowly unwound long-term capital's positions, quietly, without the fire sale everyone had feared. As the panic of 1998 faded, many of the fund's bets, the ones the models insisted would eventually converge, actually did. The banks that had rushed in to save it mostly got their money back, but long-term capital itself was finished. By the year 2000, the fund that had once been the envy of Wall Street was wound down and closed for good. The machine that could not lose had lost everything, and its investors, the true believers who had begged to get in, were left with almost nothing.
You might expect that to be the end of the story. It wasn't. Because John Merriweather, the man who had already blown up once at Salomon and now a second time at Long-Term Capital, did not walk away. Within a year, he opened another hedge fund, built on the same kind of thinking that had just failed so spectacularly. For a while, it worked again. And then, in the financial crisis of 2008, that fund was hit hard, suffered enormous losses, and shut down too. The same brilliant man, the same style of bets, the same ending, now for the third time. It's tempting to call that bad luck. It might be something harder to accept. Because the story of long-term capital was never really about one fund or one man, it was about an idea that keeps coming back. The belief that if you are just smart enough and your models are just precise enough, you can remove uncertainty from the world. That you can measure risk so perfectly, it stops being risk at all. Long-term capital had the finest minds money could buy, the mathematics of Nobel laureates, and the trust of nearly every bank on Wall Street. And none of it saved them. Because their models were built on the past, and the future is under no obligation to repeat it. The rarest events, the ones the math says should almost never happen, are so often the exact ones that decide who survives. And there's one last echo, easy to miss. Bear Stearns, the single firm that refused to help save long-term capital, that would not put in 1 cent, was 10 years later the very first Wall Street giant to fall in the crash of 2008. The rescue in that quiet room had bought the system time. It had not fixed what made the system fragile. So think back to where we began. The smartest men in the world, 2 of them Nobel laureates, building a machine that simply could not lose. It could. It did. And the most dangerous idea in finance is still the one they believed without ever saying it out loud. That this time, it was different. It never is.